Even Bitcoin, the white paper is titled a cash system, right? For payments, people largely use it as a store of value, not payments, right? All about emergent behaviors.
I think we've seen with multiple projects, if you don't distribute any revenues back to the token or some locked token or whatever, then the token becomes really disconnected from the success of the project. There are, at the same time, projects which don't distribute much back to the token holders at all, but the price and market cap are relatively high. That's probably because they formed like a cult around the token in a sense. In principle, even Bitcoin is a store of value only because there is a cult which is formed around it. I figured out a de-liquidation algorithm which essentially turned into CurveUSD.
This is the holy grail, right? This is earning yield on Bitcoin with no impermanent loss. Hey everyone again, thanks for joining. I'm Maddie, one of the two co-founders of Legion. Of course, Legion being a platform for token sales. I'm super excited to chat with one of the most exciting designs for tokens I've seen in a long time. Michael, the man who needs no introduction, co-founder of Curve and YieldBasis as his new project, which we'll dig into in a second. And Vasily, founder of Valueverse, a token analytics platform, and a really one of the best analysts I've seen in the token design space, and early analyst of the mechanisms behind YieldBasis. So, Michael, do you want to just give us a super brief personal introduction before we dive into everything?
Sure. Well, I mean, as you already said it, that I'm founder of Curve and YieldBasis, but I would say that way before that, I worked as a physicist, did a PhD in experimental physics, but later I went to software engineering side, and at some point founded actually NewCypher, which is now a part of Threshold Network. And at some point in 2020, I launched Curve, and right now launching YieldBasis using something I learned from essentially working on Curve.
Vasily, do you want to touch on Valueverse?
I want to touch a little bit on myself, like a short personal intro. So I'm a chemist. I'm PhD in chemistry. Worked on solid state chemistry in past and pivoted my career to crypto on some point, like minus since 2013, and fully focused on crypto in 2017. And I've focused on token engineering because I think it was one of the most unexplored area in the whole sciences about crypto. And I designed a lot of tokens, analyzed it as well, and all my research led me to creating a value capturing theory, the theory that decomposes digital assets into the value capturing origins of value and mechanisms and stuff. And I'm building a big analytic product around that. And regarding YieldBasis, so this was token that came to the spotlight, and I found it one of the most exciting designs over at least this year as well. So, and I dig a lot, made some first research on YieldBasis, which was quite exciting for me, and people also, provided really good feedbacks, a lot of, virality and repos. So, and yeah, just happy to be here and also help community to understand YieldBasis economics.
Awesome. Well, appreciate you guys both being here. So Michael, obviously, as we've mentioned, you created Curve. You also created VE Tokenomics, right? Vote Escrow Tokenomics. Before getting into YieldBasis and its token design, I want to chat a few lessons from that experience. Would you say that VE Tokenomics is the greatest token mechanism ever invented?
Possibly. Possibly, but I mean, it's probably better to ask this question to Vasily, because he looked at different token designs. To be honest, VE Tokenomics was, I would say, kind of the idea of it was created in May 2020 and implemented by August 2020. So it was essentially the time it took to make it, and it was just an attempt to do something better than just one token, one vote, right? And maybe the idea was this. Was kind of inspired by real observations in stock markets, like some basically looking at manipulations which we can call governance attacks now. Imagine shareholders voting, well, with stocks to essentially stream the revenues to stock buybacks, right? So stock goes up, but the actual business actually suffers. And at the very top, before a disaster due to funds not being used for business hit, they short the stocks and, well, I mean, they sell and they short the stocks. Then, the market realizes that a company wasn't doing great. Stocks go down and they double dip. And they, after that, they, buy the dip or whatever and enter again, and they actually profited massively. Why is that happening? Well, that's happening because they have one share, one vote rule, and they can exit at any time by selling the shares. So I thought, what if we have inserted time into this? So if you are committed for some time, maybe your voting power should be bigger. And maybe if you are committed for 0 time, your voting power should be 0. And that's how VE tokenomics was made. So it was, in a way, intended as an experiment, and it was obvious that it's still better than 1 token, 1 vote. It appears that it's not only having governance consequences, it's also working as a really good supply sink for the token. And, well, it led to buying votes, right? So it was not quite anticipated. And
are you referring to Convex in particular?
Yeah. Well, Convex. I think the concept of buying and selling votes was not really introduced by Convex. It was.
But that was the kind of the industrialization of
yes,
right? It's a whole new protocol.
Convex did industrialization. It was created before. It's not for that, but it did. Well, it didn't industrialize vote buying and selling. And, well, it's interesting to see what what this industrialization causes. So it appears to be not too bad if you essentially buy this place to buy and sell votes, right? So you are, I mean, in normal world we would call it corruption, because if someone is appointed to some to have some function in like governance and whatever, and then they are bribed so they can make decisions which are in general bad. But if they bought their place, right? So they are kind of committed with their money to that place, and I mean bought in for a very significant price. So it's like they really bought a piece of the system in a sense. Then they are kind of more thoughtful, and then it's this all phenomenon of buying and selling votes appears to be actually working, and that was unexpected and surprising. And I didn't expect buying and selling votes at all when I came up with VE tokenomics.
Awesome.
So yeah.
Emergent behavior, right? As we say,
right? Emergent behavior and working differently from what we've seen in real world.
Yeah, I mean, it's a common thread in a lot of tokenomics, right? The even Bitcoin, the white paper is titled a cash system, right? For payments, people largely use it as a store of value, not payments, right? All about emergent behaviors.
Right, but you cannot really bootstrap store of value just on nothing. So it did work as payments and still used as payments, but yeah.
Yeah, I just want to add a couple of cents on V-tokenomics, because I mean, V-tokenomics is one of the most classical examples of mechanism design. I mean, some truly battle-tested and like mechanism design explored on big system, right? Because there are a lot of ideas, but I think that only those are worth that we have, some proof over years with a lot of money there. So what Michael created, he created alignment between, voters' actions and their future, profitability and their future, so because they cannot sell, right? So this, and the monetization of voting happens because this voting is really important. It is really valuable because the majority of governance, they're truly not valuable, right? This is why we have apathy of voters, apathy in DAOs and all this kind of stuff that people try to solve for years and nobody come to the vote because this vote is really meaningless. Nobody can, influence it. Nobody can derive any real value from that. And since curve position is locked, you cannot get easy access to that. So you can only buy the vote if you want to make some lobbying. If you will say it is not a bribe, but lobbying.
Yeah. No, it's fair. I mean, I think, bribe is maybe not the best term because you do see this in a legal sense in the stock market as well, right? Somebody promises like, okay, I'm going to launch a takeover thing, and if I win, I'm going to pay out. I'm going to liquidate the company, right? Like Robert Leshner recently tried to take over that liquor company that was publicly traded, and that was essentially right a legal way of getting people to vote a certain way. Of course, didn't work out in that case, but. All right. Well, moving on. I think we all can agree, kind of VE tokenomics, changed the game. Definitely brought in this aspect of aligning incentives long term, which is one of the key mechanisms here that I love. If you were launching the Curve token again, though, if you're doing all this over again from scratch, what are some of the lessons you've learned? What would you have done differently?
Yeah. Well, I would say I'm applying some of these in YieldBasis in a sense, right? But yeah, it's a few things. One is in Curve tokenomics, apart from the general alignment, there are boosts, right? And boosts is this. When liquidity providers may provide liquidity, they earn some CRVs, right? So if they locked CRVs, they actually earn more CRVs when they provide liquidity, so they kind of boost. But that happens at the expense of others, right? But when we have aggregators like Convex, like StakeDAO or YEarn introduced, then they can boost, and they can boost up to like whatever boost rate. So boosts work very well initially at the bootstrapping phase. But later on, what they cause concentration of voting power in secondary projects like Convex, StakeDAO, and so on. And in principle, that's not too bad. It's not too bad because these projects can do BD for you, for example. So you kind of outsource some of functions without actually telling it, right? So if you don't have something, they will replace it and make it, in a sense, well, like several projects working together. That's probably great, but also that can be seen as a risk because there is a lot of voting power concentrated within one or very few projects. And that happens, I think, due to boosts, because these large projects, they collect a lot of VE-CRV, and they can boost multiple pools at the same time. If someone individually provides liquidity, they usually need very few pools, right? So they provide liquidity in one or two pools, they boost themselves and so on. But they in principle could boost all the pools, but they wouldn't provide liquidity in all the pools. But these projects would, so they are having an advantage over individual liquidity providers, and that is why boosts make these secondary projects to grow. And I'm not sure if it's necessarily always a good thing. So I think it's probably good as is in Curve, but why not try to see what happens when you have no boosts? And that's what I'm trying with YieldBasis. Whereas all other things, like token earning revenues, locked token working, getting revenues from the system and voting and being committed by time, that thing remains.
Yeah.
So that's one thing. Another one which was very often brought up is something pioneered by I think initially solidly, and then the most successful forks were like Velodrome and Aerodrome, right? So when you align voting with revenues which individual pools get, right? So if you over there you have actually this, so it's something I would say concerning the revenue distribution. You over there you get revenue only from the pools you voted for, and those pools get only inflation, but they don't get this revenue. And in principle, that is an interesting design. And it really works well when you have, I don't know, a casino-like operation, when you have many coins and, one coin pops up and then another pops up, and then you have a lot of hype and a lot of trading, and like that's generating a lot of trading volume, but then these coins essentially die, but new ones replace them and so on. So this is, well, I mean, centralized exchanges work as crypto casinos anyway, so that's probably working as their competitor in a sense. But maybe it's not so good when you want to form a very long, ultra long-term sticky liquidity. And in YieldBasis case, it's probably also not a very good one, because you have essentially one or very few types of assets, like BTC or BTC and ETH and so on, and they don't really produce, I would say, they don't really produce vastly different amounts of fees from each other. So you probably doesn't make sense to vote for one versus another. And also imagine that even on Curve, imagine that you have strategically important assets like stable coins or staked ETHs and so on. And then some, I don't know, some degen meme coin appears, and it attracts most of the inflation towards that, away from those strategically important assets. And that's, I don't know if it's good. Probably not necessarily, but it's good when you operate as for casino assets, right? But when you put really like super long-term assets in the mix, it's not so good. So I think I would probably not apply that one, but it's a very interesting twist to tokenomics, and it definitely serves its niche. And I think another one, which I'm doing in YieldBasis, and so that's probably the most important change in token economics. Well, currently in Curve, liquidity providers earn both pool fees and inflation. So, I mean, every liquidity provider can earn both. And they don't earn the full pool fees. They earn half of the pool fees. Another half goes to admin fees on Curve, and liquidity providers get whatever inflation is defined by voting. So that's that makes it not very convenient to integrate with different platforms, because they need to figure out how your token farming works. That's one thing. Well, I mean, of course, they can wrap it as a different asset and make it automatically dumping your token, but that's probably not ideal. And another one is that not all people want the same thing. Some people want to earn your governance token, and they just want to farm it. And some people want to earn the original asset and auto-compound it, right? And they are not necessarily the same people. So what we do in YieldBasis, we actually split between those liquidity providers who want to earn fees and liquidity providers who want to earn governance token. You can earn one or the other, but you cannot earn both at the same time. And that creates really interesting consequences, apparently. So, I mean, sounds like a simple change, but apparently it's a very profound change.
Yeah, no. I definitely want to. We'll definitely get into that and want to hear the reasoning. But to summarize back to you before going to Vasily, kind of the three biggest learnings from Curve that you're already also taking to YieldBasis. One is kind of smoothing out the impact of boosts so that large players don't become even larger. Two is keep the incentive slowing to kind of the key asset pairs that hold most of the TVL or stable kind of asset pairs in the long term. And three is this division of you can either earn trading fees by LPing or you can earn emissions, not both at the same time.
Yeah.
And
By the way,
we'll talk about that.
By the way, this division is not really appearing out of thin air. It was actually inspired by what Convex does. On Convex, when you have CVX CRV, you can earn either fees from the system in essentially US dollar denominated, or you can earn CRV and CVX. CRV is coming from a part of the CRVs which Convex got by selling boosts essentially, and CVX is from CVX inflation. So you can choose one, which is CRV plus CVX, or the other, which is USD. And over there, you can actually choose a portion. So you can say, oh, I want 40% in that and 60% on that, and so on. But actually, it looks like most people choose 100% of that, 400% of that, and I find that really, really convenient, to be honest, as a user. So sometimes I want one, sometimes I want the other, and I do use this switch, and it's been great. And also APRs in the volatile assets and stable coins over there, they equalize. They equalize actually, because the efficient market leads them to be almost equal. So you don't actually have to jump around if you really need cash from that, right? From that system, then you can choose to earn cash and set and forget. Or if you really want to invest, and if you believe that, if you don't have plans for this cash, but you believe that this everything will go up in future or whatever, you can choose to earn cryptos, and again, set and forget. And you can claim from time to time and whatever, but yeah, both work pretty well.
Awesome. Well, it's an interesting case of the protocol that was inspired now inspiring the next protocol. So
right. So it's some recursion happening here. It's a little bit reminds me how quantum mechanics appeared, because one physicist basically wrote another, and then they wrote back and they started collaborating, and it grew up from essentially nothing to like nice science. So here it's kind of the same thing with projects.
Yeah, I think in crypto we have a lot of ideas that are spreading up, right? Somebody built, you find this good one, you modified it, you include it to your own protocol or some design. For example, I don't know, would it be necessary here, but for Aerodrome, liquid products, they can choose, do they want token or they want trading fees from their position, as Michael said before. But what I found out that the price the price level that you pay for getting IRA emission from your yield that you provide to Tokenomics is significantly less than is a market price. For example, like yesterday, the token was $1.33 and the farming price was 0.8 only. So 40% gap, like arbitrage gap between what you can mine and how you can sell on the open market. And this is because people, don't have any choice, I think. And second, because they just don't aware, I think, about that. But it's very interesting consequence. And in YieldBasis, probably we will have something like this, but it wouldn't be so big gap. But it's, of course, like purely theoretical at this moment because the protocol is not launched.
Yeah, well, I think actually these gaps exist in many projects,
and surely they'll exist even in YieldBasis at least temporarily, right? There'll be certain market conditions.
So it's basically, you can say that I would say the project is not kind of not sustainable because it spends more inflation than it makes back in fees, right? So that's essentially another way to formulate that. But I think that also happens because you have initially some distribution phase of the token. And this distribution phase can be fairly long. It can be multiple years. So, and essentially this premium, how much, well, this inefficiency, I would say, right? It exists, I would say, only while this distribution phase lasts. But we have essentially all DeFi protocols still in distribution phase. I mean, if it wasn't the case, then you could argue that Uniswap token price should be 0 because it doesn't redistribute revenues. Yet it's not 0 because, it's still in some sort of distribution phase.
And to go back to your kind of earlier stock market example, you also see roughly the similar thing in growth stocks, right? Like a company like Tesla, a high growth company like Amazon, they could spend years, they can spend decades before they're actually paying any earnings out to shareholders, right? They're just reinvesting it. They're in growth phase. All their classic valuations based on cash flows and earnings would break down, right?
Right. But the thing is, if you are distributing your tokens constantly, right, then inevitably this creates some of the downwards price pressure. So you cannot afford to not distribute anything. You have to do that. And also, I think we've seen with multiple projects, which are actually really good, that if you don't distribute any revenues back to the token or some, I don't know, locked token or whatever, then the token becomes really disconnected from the success of the project. So especially I think this is true for DEX aggregators because it's not easy to monetize those and give the value back to the token, although I think it's still possible, but it's not easy. And there are, at the same time, projects which don't distribute much back to the token holders at all, but the price and market cap are relatively high. That's probably because they formed, I don't know, like a cult around the token in a sense. In principle, even Bitcoin is a store of value only because there is a cult which is formed around it. Although, of course, there are some nice properties of Bitcoin, but it's really simple. It's like cannot break, and it's I would say very, very disaster proof. So that's, of course, given its simplicity is its value, but there is a good meme coin aspect to that as well, and that's true for many protocol tokens as well. And they don't necessarily have to distribute revenues, but again, they only can afford to not distribute revenues when they are not distributing the token anymore.
Yep. No, very true. And a trick is obviously in eventually maturing and switching, arguably only Ethereum is one of the few tokens out there that has done so, right? And switching to this, into their current model where they burn gas fees. Vasily, any thoughts on that?
Yeah, but you can also remember that Ethereum wasn't distributing any revenue until the merge, right? You can mine Ethereum only with GPUs. Your Ethereum asset allows you only to buy block space, so it wasn't And at the same time, Ethereum has a huge valuation. It was like top 3 in market caps, etc., etc. Now is as well. Now, of course, it's much more economically sustainable with all these cash flows and stuff. But before it was not the case. And we also have a lot of buybacks meta. I mean, the pump fund token the only function is that they buy it back, for example.
Fair.
So,
all right. Well, we've been talking about, at a high level, Curve tokenomics, how they've inspired YieldBasis. Before we really dive into like the details of the YieldBasis token, because there's some really interesting, design choices made there. I want to make sure we kind of understand how they helped the protocol, why they were made. I think it'd be good to quickly touch on, YieldBasis as itself as a product, right? So people understand the context. And so, what is the 15-second, right? The 1-2 sentence elevator pitch for YieldBasis?
Yeah, good question. I I think well well, for those who know, it solves impermanent loss. But for those who don't know what that is, it would sound like it's a single-sided liquidity provision where you can bring your crypto and it just earns fees from its volatility.
And in particular, starting with Bitcoin, I believe.
Yes, starting with Bitcoin, because Bitcoin price, I would say, has some fairly good properties for YieldBasis.
Nice. Okay. So the elevator pitch is, it sounds like a dream. Bring your Bitcoin, deposit it, earn yield on the natural
On the Bitcoin,
volatility without impermanent loss or without
Right.
with the risk of wild fluctuations for people who don't know that. Let me ask you, why are you there's a million things you could be working on. Why
Right.
are you building YieldBasis? Kind of what do you realize about the future that people haven't caught on to yet?
Well, I think one thing. First, I think that was beginning of 2022, I figured out a de-liquidation algorithm which essentially turned into CurveUSD. Right. But back in the day, I also realized that something like that can be applied to remove impermanent loss. Well, now I understand that it appears that I actually didn't have the right tools and experience yet to do it successfully back then at that time, but it was the right idea. So when I got enough learning how to simulate what liquidity pools can do, right? So to make simulations which have very good predictive power, then I realized that idea can be implemented to essentially solve impermanent loss. And also, it appears that it's actually a nice idea business-wise, because, like, for example, today, lots of Bitcoins are earning, well, I mean, of course, they are earning nothing when they sit in Bitcoin network. And if you try to find some earnings on Bitcoin in DeFi, you can find maybe 1% APR or so. So it's on average, so it's not much. And in Ethereum, it's a little bit better because you have staking, which earns like, I don't know how much, 3% today. You have restaking, which earns a little bit on top of that.
You have MEV, you have other sources.
Yeah, it's still not too much though. So you can apply this to Ethereum as well. But in Bitcoin, the need for that is really huge. And also the simulations showed that Bitcoin is actually, the price-wise, which essentially converts into safety of the protocol. Bitcoin is really, really the best for this.
Is that, really quickly, is that a function of the amount of trading volume relative to volatility?
Not well. You can say that in a sense, right? But I would say that I was looking at it from a different perspective usually, but I think it's the same thing. So if you have lots of short-term volatility, but the price is actually coming back to some trend line.
So
right?
Roughly mean reverting.
Roughly mean reverting, but very roughly, because it's actually not mean reverting.
Yeah, it's a non-static mean.
So yes, something like that. And Bitcoin appears to be very close to this, right? It doesn't necessarily apply to all assets of low volatility, but generally, if you look at I don't know, some very fresh coins or meme coins or whatever, volatility is way too high, and it's not quite mean reverting. If you look at pair like euro dollar, well, it's mean reverting, yes, but volatility is almost non-existent. So, well, because I don't know, professional traders took it all away, and it's not quite earning much. But Bitcoin appears to be perfect. Ethereum appears to be actually close to perfect, but not always. So, in few in few points in the past, Ethereum showed like it to be working worse than Bitcoin in essentially during some events, like FTX collapse, for example. But it's still very decent.
All right. Well, I have to ask: will YieldBasis be an even bigger protocol than Curve?
Well, I would say this. Even technically, it's not quite possible, because YieldBasis under the hood uses curve pools. When you put I don't know, 100K worth of Bitcoin into YieldBasis, right? It creates a curve crypto pool, which has 200K worth of liquidity. So, well, depending on how you count, you can say that that curve TVL would be either the same as YieldBasis. Well, I mean,
Always at least the same. Yeah.
getting the same addition as TVL of YieldBasis, or twice that.
Yep.
So no, I would say that YieldBasis cannot become well. YieldBasis can become bigger than Curve without YieldBasis, and I think that is what will happen.
Awesome.
But YieldBasis cannot become bigger than Curve with YieldBasis existing.
Understood. Okay, but you would say that YieldBasis will become bigger than Curve is today, if I understand it correctly.
I think so.
Awesome.
That's
cool.
the hope.
And then just to briefly, we've been talking about people deploying Bitcoin. We don't need to spend a lot of time on this, but I just want to clarify for people. When we're talking about people deploying Bitcoin to earn yield, is that a particular type of wrapped Bitcoin? Will YieldBasis have its own Bitcoin? Are you going to launch your own Bitcoin L2?
No, I think having own Bitcoin wrappers or Bitcoin L2s is a very big undertaking, and we are good at only building DeFi, not necessarily on building new chains or L2s or whatever. So no, it will be using existing Bitcoin wrappers, and I think we will start from major ones like I don't know, WBTC, CBBTC, and TBTC, and maybe we'll add some more really solid ones. But yes.
Yeah. Okay. Makes sense. Oh, cool. I think want to dive into some of the visuals we have here.
Yeah. So just super short intro to YieldBasis. So for me personally, YieldBasis is a protocol that enriches asset with some additional yield sources based on the market around asset, which essentially is happening with Bitcoin, right? So yeah, the problem is that Bitcoin is not productive asset. You cannot earn more Bitcoin if you own Bitcoin. Natively. So there are some yield options that are not attractive. The lending yields are very small, 0.01, something like that. So IMM theoretically can capture a lot of fees, but the problem with the impermanent loss that we will discuss on the next slide, there is a problem. So we will see the numbers just for the average DeFi user who are not deeply in the problem. So what if you can just get rid of impermanent loss, make it like IMM without impermanent loss by design, and allow people to earn fees on Bitcoin, but not risking the amount of Bitcoin in IMM. So what is the problem of impermanent loss, right? So if you supply your position to the traditional IMM, like use V2 for very simplicity, if your position, if the volatile asset price grows or declines, your position value is following the square root, and basically you're having less than if you hodl. Of course, if it wouldn't be enough offset by fees, but historically, from what you can observe in DeFi for more than 5 years, IMF fees for volatile pairs almost never offset impermanent loss. This is why DEX in early days made a lot of token incentives that were dumped. And anyway, it wasn't the real solution.
Well,
So
maybe before you move on to the next slide, I know
Yeah.
we'll very briefly get into the math. I love this example. I love this chart.
Yeah.
Or sorry,
Yeah.
if you just stay on this previous slide. Yeah. I love this chart because it really shows clearly, right? Like if price moves up or price moves down, people are not getting as much return as if they had just held Bitcoin, right? And the intuition there, I like to think about it this way: of when you deposit into a standard AMM, you're depositing equal values of Bitcoin and equal values of USDC, for instance, in this case, right? And if price goes up, that's because people are buying Bitcoin, right? And so people are buying Bitcoin from you as an LP, meaning you're selling Bitcoin. So now if price is going up, you no longer have one Bitcoin exposed to the rest of the upward movement, right? You have 0.9 and then less and less Bitcoin exposed to the upward movement. So as you see on that blue line, as the price rises, right, you actually have less and less return compared to just holding your Bitcoin. I think that's a beautiful way to describe it. And yeah, maybe we can get into how YieldBasis helps us solve this. Yeah.
Just for people, I made the numbers here. If Bitcoin grows 2x, it means that you have less Bitcoin, more USDC, but in total, your portfolio worth less than if you just hodl. This is not BYC, it's BTC, it's a typo. So you have 70K price difference approximately, and this is your impermanent loss, which is a big problem, and you don't want to supply your Bitcoin in this AML, right? Nobody wants. So, but what you can do to change this problem, finally solve it. So what was introduced by Michael? We can make leverage, for example, 2x leverage in a particular example field basis. So the thing is that if you get to get leverage, and leverage is provided using the CurveUSD, so this is a curve connection, right? Because CurveUSD is a product of curve ecosystem. So using the position in the pool, like CurveUSD can be borrowed, and you can finally double the position of the user inside the pool, and all of this works automatically. The user doesn't need to do anything. It's just a product that works from scratch. So, and we will find out that the growth of position value, so if you will see the P and DP is the change of the price, right? And versus the price itself. So, and one is the leverage position, another is not leverage position. And we will find out that for leverage position, this P with this symbol is proportional to the L power. And if we do the leverage is 2, it means that it's proportional to square root power of 2, and the value of position is proportional to the price of volatile asset. It means that if you supply 1 Bitcoin to the YieldBasis AMM, its price grows 2 times, you will still have 1 Bitcoin. And this is like a holding on spot, but you also earn trading fees, all this pathway to 2x, right? So you have more Bitcoin than before. This is the idea.
Okay, awesome. Yeah. I mean, I guess because your exposure in an AMM is essentially the square root of your position, right? If we take the derivative of that, we have half, and so we need to multiply by 2. So we need to be 2x leverage to get back to having that full exposure. I guess for the non-math people, right? We just talked about how if price is going up, you have less and less Bitcoin. The leverage helps solve that if you still maintain the same level of exposure to Bitcoin prices at each step. And the rebalancing,
this leverage should be be maintained on all times. Of course, this is very important. I even put here the rebalancing leverage, because if you just put the leverage at the initial stage when you supplied liquidity and you didn't update it, you wouldn't offset impermanent loss, but it will be better than without this. But anyway, it wouldn't be the solution that is created for YieldBasis.
Okay, cool. So it's leveraging up, and it's automatically rebalancing as well at the same time. I do want to ask, because this does relate to maybe not the YieldBasis token itself, but the economics of the system. Why are people, obviously when there's leverage, somebody's borrowing something to get that additional exposure. So why are people lending Bitcoin to YieldBasis LPs, right, instead of LPing themselves?
Right. Well, nobody lends Bitcoin, actually, right? What gets lent to build leverage is USD, essentially, CurveUSD. And why CurveUSD? Because it's essentially, lending from protocol to protocol. In this case, from Curve to YieldBasis. And of course, then the question is, what does Curve get in return? And interestingly enough, I was working on that just yesterday too, right, in a Curve proposal. But in brief, one thing Curve gets is part of YieldBasis YB token allocation. And another one is if all the pools are pairing wrapped Bitcoins with CurveUSD, and what is present on centralized exchanges and everywhere is pairs of Bitcoins with essentially USDC and USDT, there will be necessarily always a trade between CurveUSD and USDC or USDT or something when somebody arbitrages YieldBasis, or maybe some other swap is happening. And that volume through, most of all CurveUSD stablecoin pools are located on Curve, and they will earn fees. And you may think that these fees are small, just 1 bips, but it appears that revenues the Curve gets from that is not too small. So the volumes are not small at all. In addition to YB token inflation, it appears to be fairly good deal.
There must be some kind of market-driven mechanism for pricing the level of compensation.
Yes. So I tried to estimate of course we don't know what YB price will be, but having a few observations of what we have on the market, it's possible to estimate that. And in addition, there is a much more solid estimate on what returns from CRVUSD stablecoin pool fees will be.
Mm-hmm.
And overall, it appears to be, comparable with what VEYB is getting, maybe 50% of that or something. Plus minus, depending on the market condition. So, and another thing which I actually think is good to do. So YBs which are getting to Curve, right? What to do with those? Because they, of course, can be distributed to CRV token holders, yes. But maybe a better way is to use them to buy votes for CRVUSD stable pools, so that CRVUSD has more liquidity, bigger supply sinks, and that creates also more borrowing of CRVUSD inside Curve itself, and that would increase revenues over there for all.
So Curve becomes the convex of YieldBasis. Very interesting.
That's an interesting way to think about it.
All right, awesome. Well, I think we've covered kind of the basics of how YieldBasis works, right? Even if all this math just went over listeners' head, right? The key takeaways is we're depositing Bitcoin, we're doing some dynamic rebalancing and leverage in order to hedge out, if you will, impermanent loss, right? And so I'm only making yield from the trading activity and the volatility in Bitcoin, and that's powered in part by CurveUSD as LL behind the scenes. Given that's the product, let's go into now, Vasily, if you would please, to kind of the token, right? Let's talk about the YB token. What does that do? Why is it important? Would love to learn more about that.
All right, so what is the genesis idea of YB, as I understand it, right? It's to establish a governance system that aligns, token holders' intention and the success of the protocol. So what is the success of the protocol? More Bitcoin, more pools, more trading volumes, more yield, expansion growth, etc., everything good that we can, think in mind about YieldBasis, right? So what we need to do to achieve that. So thanks for Curve. We already have a lot of answers here, so we don't need to do it from scratch. So vote escrow is a brilliant model for that. Why? Because people, cannot borrow, cannot make governance attacks. People have full alignment with the protocol. So if they vote for something really bad and it destroys the protocol or makes it less valuable, the value of the token holdings are going down. The amount of fees also going down. The protocol is less attractive, less adopted. So in Tokenomics, we have two ways of this alignment. It's very important just to understand on the theoretical level. First way is protocol fees. The bigger the protocol in terms of metrics, and metrics are trading volumes, CVL, etc., the more fees are captured. And the second is the price of your position, so your capital that is inside the position, which is locked. And of course, if protocol thrives, probably the token, value can grow in the future. So, and all the tokens without vote escrow, they have, without protocol fees distribution, they have only this, like price dependent thing that, of course, if protocol will work better, the price will grow up. And, this is only this. So we have vote escrow as an alignment mechanism to prevent governance attacks. We have protocol's fees distribution to create this positive feedback loop. The better governance decisions, the better the protocol metrics, the more fees are distributed, right? We will also dig a little bit more. And the third point is the YB emissions. So the YB emissions, this is very tricky question that we already discussed with Michael. So to get access to emission, it implies capital cost to liquidity provider. So it means that you essentially need to give your yield away, or not away, but to the system itself. So it's split it to the VYB stakers, and some of it is going to YB BTC. So I will show all the math next slides. But the thing is that you essentially buying a token from the protocol under the protocol mechanism design. This is how I can interpret this mechanism.
It's not exactly how it works under the hood, but it's equivalent to that, yes. So it's some equivalency which didn't quite occur to me. So it's an interesting observation.
It's like buying it, or it's almost like mining it, right? Which I think you guys have used as an analogy as well. But so if I understand it correctly, I mean, overall, the YB token is used for governance. It's used for earning fees, right? On the governance side of things, what type of things are people governing? What are they voting on?
Yeah, of course, one thing they are voting on is pool parameters. Because the operation,
such as the trading fee and these sorts
trading
of things?
fee, liquidity concentration, and this trading fee is dynamic, and also this the re-leverage, the AMM. There is an AMM which keeps leverage constant. It also has its own fee, and basically stuff like that.
Okay.
And another one is which new assets to include in YieldBasis, which Bitcoin wrappers, for example.
Might also want to add a little bit that emission allocation to pools, of course, is governed, which is very important, at the same as in Curve, and also max emission per period can be also governed theoretically. And what is very important, that this governance system, it is not multi-sig type of thing, not like the majority of DeFi protocols. So team multi-sig, they cannot do governance decisions, right? Only vote escrow YB holders do the decision, and the decision are implemented via the enacting transaction. So it's not like if team will on the multi-sig decide that we okay with the decision, it will work. No, it's not the case. It's not multi-sig DeFi.
It's true decentralized on-chain voting, and I like it. Very, very rare these days, but obviously
only decided by Vitalik himself.
Yeah. Well, okay.
I mean, imagine the protocol that can theoretically have billions of TVL from holders of Bitcoin, right? If team can do anything that they want with multisig, it's crazy. So it's not like
that is a great point, actually. Yeah, because and especially people who hold Bitcoin often hold it because of to have its simplicity, to have the security. So knowing that this is not a multi-sig behind the scenes, knowing it's true on-chain governance, that is a big piece of mind.
Yeah. It in other protocols, when they have this multi-sig type of thing, it adds a layer of risk,
absolutely.
Right? And here in Curve and YieldBasis, there is no this kind of risk.
And the vote escrow mechanism helps prevent any kind of theoretical governance attack risk that would exist, right? So it makes a lot of sense.
I can add even more here. So the voting. There also was an idea for Michael. I don't know, is it implemented finally in code or not, but we discussed it before that your votes are worth less if you cast them at the end of the voting to prevent this last minute.
I've thought about governance proposals like this before, so I'm glad to hear someone's implemented it.
That was done even for CRB.
Amazing.
And that's basically the voting time is 1 week.
Yep. And the earlier you vote, the more your vote counts.
Well, first 3.5 days, your voting power is constant. It's what it should be, and then it starts decaying and decays to 0. So last second vote has 0 power. And I did see an attack, which was a long time ago already. I wouldn't say it's maybe you can call it an attack. So basically, there was one there was a vote for one collateral, or one asset to be included in Compound, I think. And there was one big voter, I think it was Parafai, who had quite a lot of votes delegated to, maybe from A16Z or something. So they didn't vote till the last second, and in the last second they flipped all the results of the vote. And maybe if they voted before, some other voters would have stepped in and made a different outcome. But because they did it in the last second, everyone thought, oh, okay, this is gonna pass, but it failed because of the last vote.
It reminds me of like eBay auction sniping, right? You
bid
right at the last second, try to
right.
Yeah. Well, cool. I mean, I know there's a lot to dig into here too, but hopefully we can keep moving along. Fascinating conversation. I do want to ask, before moving on to the next slide, we seem to be in an era where buybacks are super popular. And so what are kind of your brief thoughts on why to share protocol fees with VE stakers instead of doing token buybacks?
Fundamentally, how to measure whether buybacks or VE tokens are better? Well, one way would be to see how quickly one or another removes tokens from circulation. And if you have buybacks which don't burn the tokens, then they will eventually get back into the circulation. So that's probably worse than buy and burn, right? So buy and burn has been fairly popular recently. Anyway, so we tried to make to calculate, to measure how much CRV we would have burned if we did not distribute everything to VE CRV, but actually bought CRVs and burned, right? And it appears that on the graph you see it as a green line, and orange line is how many tokens are locked as VE CRV. So it appears that token locking, VE tokenomics, is simply maybe 3 times more efficient than buy and burn in removing tokens from circulation. But I would say, why projects do buy and burn? Because it's a good meme, right? Especially in Asia, it sounds like an awesome narrative, and that's why people do it. And then they have all these narrative-based price actions, right? And I don't know, like just narrative is not enough for price action, and I'm not really an expert in that, so probably it's just better to focus on how to efficiently remove tokens from circulation.
Not an expert, says one of the creators of the top DeFi protocols of all time.
Right. Well,
differ.
Not expert in any price manipulations, not a speculator.
Fair. Yep. Okay. All right, well, let's move on. I know I want to get to your next slide, Vasily. There's a lot of moving pieces here, right? We have the YieldBasis token, we have the vote escrowed YieldBasis, we have LP tokens. Can you help break it down for us?
Yep. So, as I remember, if you want to activate YB utility, you need to lock it in vote escrow. Then if you vote, we get some governance power. If you don't vote, we get only protocol fees. Right, so this is how it works. But we have 2 more assets besides YB and vote escrow YB in the system, which are very important to understand. First is YB BTC, the LP token of YieldBasis. So it means that you provided your wrap Bitcoin to YieldBasis pool. Hopefully it will happen shortly, right, when the protocol will be launched. So you get your YB BTC, generalized LP token name. But this LP token provides you spot exposure, right, as we discussed, non-joint loss. It's liquid, so you can move it, do whatever you want with this token, and you are receiving trading fees in Bitcoin, but you don't receive any YB emissions. So if you want to receive YB emissions, you need to do what you need to do. You need to stake it in the special staking contract and receive a staked version of YB BTC. So it's as well LP token, so it's the same position. Nothing changes. Your Bitcoin is still your Bitcoin, but you're not receiving trading fees anymore. So you're participating in YB emissions, right? So it's inside the contract, so you cannot move it while you're receiving YB emissions, but you, of course, cannot stake it at any time. No lockups. It's not what is Crow Tokenomics. It's just like contract where you deposited this LP token. And you receive YB emissions, but you not receive trading fees. So it means that your trading fees in Bitcoin will be zero. You will still have your position, like your how much Bitcoins that you supplied, but you will receive YB tokens. And how the amount of YB tokens is calculated, you will ask me. So there is some amount of like Emax for each epoch, and the amount of daily emission depends on square root from the stake rate, and the stake rate is the like share of liquidity providers who decided to receive emission. For example, it's 10% of YBBTC holders decided to stake the YBBTC. It will be like 10% or a 0.1 stake rate. So yeah, and also I think it worth mentioning how the admin fee is distributed after that, because so what we have, if you're going back, we have YB token holders who didn't lock into VYB. They have no utility, so you can like buy and sell and transfer your YB token, but you don't receive any governance rights, you don't receive any protocol fees, you receive nothing, right? No utility from the common sense. If you stake your or lock your YB in Vaults CurveUSD from 7 days to 4 years, you receive governance right, yield from protocol fees that we will describe next slides. You cannot move your position, is the same as in Curve, and your yield source is admin fee, right? So, but let's discuss how the money is really distributed, how the yield is distributed. So, we have 4 tokens.
Yeah, I was just going to hop in, but before we go on to the next slide, I would love to talk about this, even this first aspect of like why it's emitted, the token, but maybe you're about to talk to that. There's a lot to dive in here too, right? There's this interesting decision about if you stake your LP token, you earn emissions, but if you don't earn emissions. There's kind of the shape of emissions, and then there's the splitting of fees. So there's a few different aspects to talk about. Before we dive into everything, I just wanted to help people understand. Let's break it down into pieces. Maybe explain some of the intuition, right? What is this trying to achieve? What is this trying to incentivize? Because most protocols, when you deposit LP and stake it, you earn the trading fees and you earn the native token emissions. So why this decision in YieldBasis case where you're only earning the trading fees or the native token?
Okay, so I will share my view on that because Michael shared his view before, and my view on that is follows. So if you just deposit your Bitcoin and your liquidity provider, you earning your Bitcoin fees that you get from your position, you are just a user. You're not like a co-owner of the future of the protocol, right? You're not the core community. You're just a user. So you come to the shop, you buy some groceries, or you do something. Why the shop needs to provide the some future yield or something for you? It's not like this. But if you decided, okay, I will provide my yield to the protocol, like stakers, to the Vaults CurveUSD, and of some of this also going to remaining YBBTC holders we will discuss, but a significant share can also go to the YB. You receive some tokens, and the YB tokens, you're not became the owner of the protocol, right? You're not became the owner of the contracts. You get a share in all future admin fee, and you get a share in all future governance rights, right? This is what you really get. You get the share of the future, utility, right? And this is logical from economic point of view that if you want to be I can see the shareholders at a share, right? But if you want to be, like the participant of these two value streams, because governance is a value stream, specifically if there will be theoretically some, bribes or monetization for governance, admin fee is a value stream. If you want to get share in that, you need to to also provide something from your side. Why you will get it for free? In Curve, technically, Liquidity Project also pays for the token because the admin fees anyway charge it, right, from all the yield of the LP. But this price is much less in comparison to YieldBasis, at least in my understanding. So this mechanism just introduced that if you want to get tokens from emission, you just need to pay higher price. But at the same time, this higher price is also good because first of all, it goes to the existing holders. So it's in past, this token emission was the expense of the protocol to attract users, right, to make adoption. Now in YieldBasis, this is not expense of the protocol. It's a new protocol fee stream because this yield is partly going to Tokenomics, which is really good. Yeah, I just want to say that if you want to be and like get this protocol fee sharing in perpetual and get governance rights, for all the future years, you need to provide also something to the protocol besides just your liquidity that anyway earns you a lot of trading fees, much bigger than in any other like protocols for Bitcoin yield.
Makes sense.
So
no, I mean that's a good way to describe it. I guess in a similar way to why people like to sell tokens versus airdrop them. There's less of an incentive to just dump these tokens right away, right? Like you're essentially paying for these yield basis tokens and the opportunity cost of the trading fees yield you could be earning. So I like to think of it almost as like pseudo mining the YB token, right? It's an interesting dynamic.
It looks like a Bitcoin mining in some way, of course, from economic view, not from like hardware,
but,
right?
But
no,
like the hardware,
like
you're tying up working capital into this asset, right, and then giving up a yield. Yeah, makes sense.
So you have some intrinsic cost to get this asset, and everyone have the same intrinsic cost at the same time. I mean, in one pool, because the emissions to different pool can be different. So the theoretical price of YB can be a little bit different. But I think the arbitrage, since all these rapid bitcoins are easily swappable to each other, I think the arbitrage will be, making all these, prices.
And
almost
so
equal,
on that point, real quick, when you say different pools, you just mean like WBTC USDC and then TBTC USDC, these type of.
It's not USDC. I want to correct you. It's not USDC. It's CurveUSD of CurveUSD only.
But different wrapped Bitcoin is the different pools. Got it. Okay. So I think it's clear, why the emissions are only made when you're staking and not earning fees. But yeah, can you? I see you advancing to this slide. Can you explain a bit more about that shape of emissions?
Yeah. I just want to add a couple of things here, and I think probably Michael also will add some his thoughts because he was a creator of all of this. But how I understand that, so there is Emax, it's maximal daily emission that is for each epoch is calculated like remaining liquidity mining supply, which is 30% of the token supply overall. That could be mined in the future, right? Divided to 4 years, and from this Emax, which is like a maximal daily emission, there are like actual emission is Emax multiplied by square root of S. S is stake rate. What does it mean? It means that the higher is the share of the LP tokens staked, the more emission comes out, but not linearly, but depending on the square root. It means that if nobody staked YBPTC, the emission is zero, right? Because S will be zero. So and if everyone staked YBBC, 100% of LP staked YBBTC, it means that that daily emission will be equal to Emax. So what we can learn from this also. So we also have the formula for admin fee distribution. I mean, all of these information on the slide works together. Kind of describe separately to have full understanding. So admin fee is what Tokenomics stakers receive, right? What
the protocol collects as its fee, basically.
Yes. This admin fee is not denominated in anything. It's just like a share, right? It's a share of all the trading fees yield. So what this formula can say to us? First of all, we have A. It's a minimal admin fee. So if nobody staked the BBTC, the A will be 10%. So what we will get like S is 0, so square root from 1 is 1. 1 minus 0.10 is 0.9. 1 minus 0.9 is 10. So admin fee will be 10% if nobody staked the BBTC. This is like some extreme case because looks like somebody probably will stake. So then if there is some stake rate, so some part of YBBC holder decided to not receive Bitcoin but receive token emission, and parties decided to receive yield. So let's calculate it for the case of 50% stake rate. 50% of liquid provider decided to receive token emissions, 50 decided not to receive. So I just provided all the calculation here for our listeners to see how we got to these numbers. So in this case, the 36% of all yield of all trading fees in the protocol will go to vote scroll economic stakers, and 64% will go to YBBTC liquidity providers. What is interesting that only 50% of YBBTC staked, and now this 50% of remaining non-stakers receive 64% of the yield. It means that they also receive more than before. So, which is interesting.
Yeah, I think that is interesting. So I wanted to ask about why that shape of this curve, right? Because as you mentioned, it's not linear. So again, just to repeat the example really briefly, if only 50% of the Bitcoin, LP tokens are staked, then those stakers get 64% of the emissions, which is a function again of this sublinear curve. What is that trying to
Right.
incentivize in terms of user behavior?
Yeah. So imagine that more and more LP tokens are staked, right? Maybe imagine not 50% staked, but 99% staked, and only 1% not staked. So this 1% will earn actually significantly more than 1% of fees. And basically, the smaller this not staked part gets, the bigger fee APY will be, right? So that's why it's made this way. And the same actually applies to the opposite side. Imagine that very, very small fraction of YBBTC is staked. Let's say 1% staked. If 1% is staked, then S is equal to 0.01, and square root of 0.01 is 0.1, 10 times bigger. So it will get, essentially 10x rate from emission, while the emission will be smaller. So like total emission is smaller, but the rate which is like the stake users are getting is getting larger. So that's why this square root shape. It's to essentially make these limits like 100% staked or 0% staked actually kind of unattainable, because you have infinite APR there, but at the same time you want your inflation to go to zero when nothing is staked, as well as you want admin fee to go to maximum when everything is staked. And actually that is that what I just said is actually fundamental, because think about it. Imagine that everyone stakes, right? Everyone stakes 100%, right? So nobody wants your real yield. Everyone wants tokens, for example. Where would the earnings go in this case? Well, they should go to the system, right? So admin fee ought to become 100%. And the same kind of applies to the opposite. Imagine that nobody is staked. Then nobody wants your emissions. Why do emissions at all if nobody wants them, right? So you have to work around these limits, right? And then we want this property of APRs getting infinite as you get to very small here or very small here. So the system will find some equilibrium somewhere in between, and I don't know. That will be told by the market, I think.
So, Michael, you're talking about the dynamics of these as we approach the extremes. If I understand you correctly, essentially what this is doing is, if there's an extreme of a lot of people staking, it becomes all else equal more attractive to unstake and earn the trading fees, and vice versa if there's an extreme of people not staking. Yeah, interesting. Okay. And so really when we think about the YieldBasis token, to summarize kind of what we've been talking about, because there's quite a few interesting mechanisms here, and I'd love to hear, Vasily, your thoughts on kind of the key takeaways on complex arbitrage mechanisms that might arise. We've got this token that can be vote escrowed to participate in governance. It also earns fees. Its rate of emission is a function of how much LPs stake or not. And the protocol's kind of fees portion is a function of how much, what portion of LPs tokens are staked or not. So what are some of we talked a little bit about it, like how this effectively means that you're kind of paying this mining cost, if you will, to farm the token because you're only earning it or trading fees, not both as an LP. What are some of the other takeaways, some of the other implications of this holistic approach to the token?
So the first result is that every liquidity provider needs to decide would he get immediate yield or get yield in all future periods, because if you're getting Bitcoin, you're getting Bitcoin right here, right now. If you're getting YB, you're getting a token that will unlock your yield for all the future and for years, including the governance, right? But if you're talking about the monetary part, at this moment the fees are more accountable than governance. So this is the first thing. Second thing is that you can always decide. Maybe you can mine, like get more Bitcoin yield and swap it to YB, right? If, for example, a YB external market price is below that YB price inside protocol, for example, YB price is like 1, and inside the protocol, and the price on the third party, exchange is 0.9, so you can just use a Bitcoin yield to buy more tokens, which also is a kind of an arbitrage. So we have two markets. Also, it looks like so this intrinsic cost can be also kind of like miner's capitulation or something, if you will see, right? It's also interesting thing. So, and if you earned a token and you paid some amount of Bitcoin from your yield to get it, if you're selling below this price, it means that you're selling at loss, right? Because you essentially paid. So, because before, when, for example, in other protocols, there was no price to get tokens, or the price was coming from some protocol fees which extremely low in comparison to the some token price at some point. So a lot of LPs just dump token rights away because anyway they get some profit from that. And in this case, this is not always profitable for you.
So you have an opportunity cost. You have a cost of production essentially, right? Unlike an airdrop or unlike these free farming.
Exactly.
Makes sense. Yeah.
Exactly. I think this allows to build a lot of products on top of YieldBasis, for optimizing yields, all this volatility. Yeah, by the way, volatility is very important. So just imagine that some YieldBasis YB BTC token holders, LP token holders, they stake it to get them some tokens. But Bitcoin volatility grew a lot. It means that over some period of time, a lot of fees were generated. It means that more fees than before, if considering that no one staked it or unstaked it during this some period of time, more fees were generated. So intrinsic price of YB became bigger, right? Because more yield was paid for the same amount of YB because the stake rate didn't change. So it means that YB intrinsic cost in the protocol is in a way a proxy of Bitcoin volatility. And it's also about pump of Bitcoin or dump, because growth or decline event anyway will have a lot of trading volumes, including arbitrage trading volumes, which will be captured by YieldBasis and all.
So do you think people will create these kind of complex volatility products based on YieldBasis?
I don't know exactly. I can say that it theoretically can be done. Because the DeFi composability allows you to build anything you want, right?
But in theory, you could build like volatility indices and maybe options or vol swaps or all sorts of interesting things.
At the very least, we already have tools which allow to do something. We have lending platforms which allow you to, to get a yield which is a little bit more stable, right? So you, you can. Some people borrow Bitcoin against YB BTC to farm, and some other they will increase borrow and lend rate for Bitcoin. So other people can lend BTC to them and earn some more stable rate, while these loop farmers have a little bit more risk. And another one would be Pendle and stuff like that. That can really convert yields to, to stable yields with maturity date. So that already can create products on top of anything, whether it's YieldBasis or not. And I think that's the beauty of DeFi. Maybe you already have all the tools available.
Awesome. Yeah, that's the beauty of composability, right? So
exactly
makes sense.
But you can build safely only in case if you know that protocol founders can change overnight everything, right? Which is not the case for YieldBasis, but the case for some other protocols can change some parameters just for multisig, and all your creations is gone. So this is not the case for YieldBasis.
Well, you can create a prediction market on the fact whether the multisig rugs the protocol or not. Which is a great insurance, by the way.
Credit default swaps on multisigs. Yeah, makes sense. Well, I think one question before kind of finally closing out, you mentioned I think emissions here. The liquidity or the YieldBasis emissions for liquidity are about 30% of total supply. What other sources of emissions are there?
Other source of emission is Curve licensing. So some token allocation to Curve, and this token allocation is 7.5% of total supply, which means it's 25% of liquidity mining supply. Yeah, so it's 25% goes to Curve directly for bribes and what Michael. Also, there is some YB pair rewards which are accounted separately. Also, and I think from the emission sides, it's all Michael.
Yeah. By the way, YB pair rewards can also go to Curve, like the YB pool on Curve, right?
Okay, awesome. Well, I really appreciate it. This has been a super fascinating conversation. I hope you guys enjoyed it as much as I did. Walking through this with, honestly, one of the best token analysts out there, especially when it comes to value capture mechanisms. So thank you, Vasily. And of course, one of the brightest minds ever in all of DeFi. So thank you, Michael, for thinking through this with me. Both of you guys, any closing thoughts to leave us on?
I just want to wish everybody a fascinating journey with YB, and my biggest advice: read the documentation, read materials, watch videos, and understand how it really works, and then you will be much more power user of YieldBasis than before. So my advice is make education for yourself, and since everything is available now.
And where can people? Where's the best resource? Where can they learn more?
I think the documentation, all the videos, all the articles, mine article, and of course, small promotion. We will do all the metrics and stuff for YieldBasis from day one. So hopefully, the metrics also will be covered.
It's also linked from YieldBasis Twitter.
Perfect. So YieldBasis is Twitter, and the handle is just is YieldBasis.
Yeah, I think so.
But the documentation was already like open source documentation code. Everything is available, and it's one of the best documentations I ever saw in my life. So
awesome. All right. Well, a lot of work has gone into it, so let's make sure people find it. Yes, that Twitter handle is just YieldBasis. Nothing special to it. No underscores or anything. YieldBasis, and has the website right there, which links to all the documentation, the white paper, the GitHub. Michael, for yourself, any final thoughts, closing thoughts to leave us on?
Probably, yeah. If you are interested, just read how it works and watch the news, and maybe try when it's up.
You got to leave us a little bit more bullish, a little bit more than that. I mean, obviously, this is the holy grail, right? This is earning yield on Bitcoin with no impermanent loss.
Yeah, I guess.
All right. Well, thank you guys for your time again. Appreciate it.